Now, for those of you trading credit spreads, of course, one of the tools that we have here on PowerOptions is the Spread Chain tool. But let's go into the bull put credit spread, and let's go to our search tool. Take a look at some of the weekly bull puts that are available for next week. NVIDIA, Williams-Sonoma, Super Microcomputer, CBOE is in there too. But let's just take SMCI for now. Williams-Sonoma looks like a good one. More stable, but the stock's at 155.43. And for the 20th of October expiration, 14 days out in time, come Monday, it'd be 11 days out in time. We're seeing they can sell the 145 out of the money put option for 70 cents, roughly. Well, midpoint, we're going to get a net credit of 25 cents. And this will put us at a 14.3% return if we can get filled at that midpoint net credit of 25 cents. We have an 85.7% theoretical probability based on the past trading range of the stock that Williams-Sonoma will remain above 145 in the next 14 or 11 days when we might enter this trade on Monday. Now, I'll just show you the basic profit and loss chart. Let's just review that for those that might be new to the bull put credit spread. What am I doing here? Again, we're selling an out-of-the-money put, about 10 points out of the money. We've got an 85.7% theoretical probability the stock will remain above that position. If it does, both puts expire worthless. We keep the entire net credit. The stock falls below our 142.5 strike price. I think it was, I'm pretty sure it was 142.5. If it falls below, well, I have an obligation to buy shares of stock here at 145. But I have the right to sell those shares of stock at 142.50, even if the stock's down here at 136. So I take the $2.50 loss between the strike prices, but I keep the 25-cent net credit, which was deposited directly into my account. So my max loss is 175 per contract. And if the stock's between the strike prices, I may risk being assigned on X amount of shares of WSM at 145, and the long put still expires worthless. So you might want to consider managing that in that case. Other triggers that we could talk about. So the midpoints here were 80 cents with a bid of 70 and an ask of 90. Very logical that I might get that 80-cent price for selling the 145. I'm sorry, it was the 143, not the 142.50. My apologies. So that's why the risk is only 175. And the bid on the 143 put is 50 and the ask is 60. Midpoint of 55 cents, not too far out of bounds. But another research tool available, which you could access here under each spread tool, called the Spread Chain. It's also in our signature tools. But linking here to further research, I can go to the Spread Chain. And this is going to take me just a moment. Spread width, I want to be 2. Okay, so I can look. Let me pause for a minute. This linked us over to the Spread Chain for WSM, where I can compare credit spreads, bullish versus bearish credit spreads. Decent way to build an iron condor position on a stock. I could just look at the debit spreads, or I can look at the put credit and call debit parity. Bull put credit spread and bull call debit, because if I'm comparing the same strikes, they'll have the same probability and essentially the same risk reward. But if one of them is giving me more bang for the buck and I have a realistic evaluation of getting the midpoint, I want to take the one with the highest return. But I got to change the criteria here because we're going to go to put credit and call debit parity. I want 2 strikes spread width. I want a minimum net credit of 2. Out of the money range, let's just go 1 to, actually I'm not even going to use the out of the money range. Minimum percent return, let's put that at 8. And the probability range, I'm going to say greater than 80. Let's see if we can go ahead and submit that and get what we wanted. Oh, I don't want that in there at all. That's probably did it. There we go. Okay. So over here on this side is our bull put credit spread. It's highlighted for us to know which one we just came through on the search. Even though it didn't show up with the first criteria we had, the system remembered what I had linked from, and here it is. With the bid spread, 25-cent minimum net credit, we're 6.7% OTM, 85.7% probability, 14.3% return, or 372.4% annualized. On the left is the debit spread, and ironically, it is the exact same return on this stock. That's amazing. I rarely see this. All 3 positions, 14 days out in time, the parities are the exact same price. Here on the bull call debit spread, though, take a look. Selling our 145 strike, excuse me. I'm sorry. Yeah, selling the 145 strike, a bid of 11, ask of 1140. With an in the money call, I'd say that 1120 premium is pretty reasonable to expect. I'd probably get filled pretty quickly. This other one, though, it's 90 cents in the money. I'm sorry, 90-cent bid-ask spread, the 143 to buy. Bid at 1250, ask of 1340, submit at 1295. I'd be more concerned that this might cost me 1305 or 1310, closer to the ask price with these bid-ask spreads when I went to place the order. So in this case, it's irrelevant because they're the same strike, but looking at those bid-ask spreads here, hey, 50 to 60, 55 is reasonable. 70 to 90, 80 is reasonable. Deeper in the money on the call premiums, 11 to 1140, I'd say 20 cents there. 40-cent bid-ask spread on an in-the-money call option to sell 10 points in the money, I think 1120 is reasonable. This one causes me concern. 90-cent bid-ask spread, putting our midpoint at 1295. I'm concerned I'd actually have to pay 1305 or 1310, which means the return wouldn't be the same. I'd be more opted in this case because the returns are the same. Because I like the bid-ask spread better, I'd be going with the bull put credit spread. Another reason in this case why I tend to go with the bull put credit spread more, even if this is showing the debit spread, the parity debit spread is showing a slightly higher return, is because remember, in a debit spread, sure, if you hold it all the way to expiration and the stock does what you want, what happens to the position if you don't do any adjustments or close the position early? Well, this is the bull call debit spread. We've sold a call to deliver shares of stock we don't own at 145, but we have the right to buy them at 143. So at expiration, if I did nothing and the stock remained above my strike prices as I was hoping, essentially my broker is going to buy shares of stock for me at 143 to fulfill the obligation at 145. I get the $2 back. I made $2 on that transaction, and if we got the price we wanted, we'd have the max profit of 25 cents on a risk of 175. That's a 14.3% return. All well and good. But in a bull put credit spread, if the stock remains above those strike prices, both puts expire worthless and I keep the net credit. Depending on your broker, and yes, commission fees are now negligible from what they were 8-10 years ago. When I had this discussion 8-10 years ago, at the time, Fidelity and Options Express, even 15 years ago, they would actually charge you the stock commissions for buying the stock at this price and selling it at this price. So at that time, the commissions were $15.95, $12.95 if you were, eventually I got to $12.95. They lowered it down there if you were on the active trader or whatever it was. But when you're fighting credit spreads and debit spreads, you're fighting for nickels and dimes. Even if you're doing 4 or 5 or 6 contracts, that $30 adds up real quick. Why take the extra transaction? Why pay for the extra fee or have to do the extra transactions in those cases if it's only 2 or 3 cents more profit, depending on how many contracts you're doing? That's why I prefer to stay with the credit spreads more often, even if there's a slight advantage to the debit spread, because they have to factor in the extra transactions to get the maximum profit on the debit spread. I have to leave it open. My broker closes it. There's transactions there where I'm technically buying stock and then giving it to someone at the higher price to get the money back. My broker might charge 2 stock commissions. They might charge 1 stock commission. They might charge just the option commission. But if the options expire worthless in the bull put credit spread, they're charging a much smaller fee or no fee at all for options that expire, depending on which broker that you're with. That's another consideration to take into account when comparing the parity trades. David says, how about a different stock? Great. Let's take a look. What's been in the news recently? We saw that big one. What was it in our cover calls? There's Cassava. Yeah, Sava, S-A-V-A. We know that this has a much higher volatility than Williams-Sonoma. And I think I might have to actually go to a 2.5 spread here, David, in order to find some results. But let's see the bull put credit to bull call debit parity, the more volatile, lower price position, Cassava Sciences. They're the same, but it's so deep out of the money. Not enough strikes. That's why. All right, let's take something with a little bit more oomph. Let's just take Tesla. And I'm going to put this back to a 2-point spread. Oh, no, I have to go to 5. So sorry, folks. We've got to put that to a 5-point spread, 8% return, 80% probability. Net credit's irrelevant. There we go. Well, here's a different example. Wow, no, they're all the same. Let's go further out. Let's go to November 3rd. No, they're all very similar. Usually you see more of a discrepancy between the credit and debit spreads. They all seem fairly priced right now, so that's pretty interesting. What was the other one we saw? That higher price stock. I'm sorry, I saw a higher price stock here. SMCI. Let's try SMCI. We'll try NVIDIA, and then we'll back out of this conversation, okay? Let's try SMCI, same criteria. I'm looking for a good, just out of the blue difference. There's one. There's two. Good. Okay, so for just next week, and this does not indicate, keep in mind, this is not an indication of a bullish or bearish move per se. This is just looking at the different comparisons. Here's our bull put credit spreads, remember, the 86% probability, good range. Selling a 245, 250 put on stock 289.67. Pretty wide, 145 to 170 midpoint there. Reasonable, 15 cents. So a 212, 213 midpoint on the sell 250 put is reasonable. This would give us a net credit of 55 cents or a 12.4% return for 2 weeks with an 86% probability. At midpoint, the bull call debit spread, same probability, is only offering a 7.5% return rather than a 12.4%. Now let's take a look at theirs, 45.70 to 48.30. That's a wide bid-ask spread, so I'm not even confident I can buy that at that 47 strike midpoint. In the money, 250 calls the same, 40.70 to 44. I'm not even sure I can get 42.35. Even at midpoint, this is worse than the bull put credit spread. And this parity comparison, definitely going with the bull put. Now, further down the line, a little lower probability, but still in that great 84% range. The 247.5, 252.5. The bull put credit spread, net credit of 55 cents with a 12.4% return. That's odd. Usually don't expect to see that, but there we go. 170 to 195, a little bit high, but 180, 182 might not be a bad midpoint. 220 to 255, it's kind of high, but 235, 238 is not unreasonable to consider. Still be around an 11, 12% return for the bull put credit spread. Bull call debit spreads offer me 13.6% return or 355.5 annualized compared to 322.2. If I get the midpoint cost of 440, which would be max profit at expiration 5 points away, 60 cents against a cost of 440. Meaning, however, 43.20 to 46 midpoint buy price for that lower 247.5, call it 44.60. I'm going to say that's going to be closer than a buy point to 45. 38.90 bid to 41.50, $2.60 bid ask spread for the in the money call with a midpoint of 40.20. Nah. I'm getting closer down here, probably to 39.80, 39.75. I don't think I'm going to get the 40.20. I don't think the potential is there in the debit spread to get that higher percent return of 13.6 with the same strikes, same probability versus 12.4 for the bull put. It's intriguing enough to try, so I'd likely go to my broker if this was the trade I'd want, and I'd try the bull call debit spread first with a limit order to not pay more than 440 or 445. If that order is just sitting there and it's not getting filled, and the midpoints are changing enough to where it doesn't look like anyone's going to give me that price at 440, I'm going to cancel the order and then try to get filled on the bull put credit spread. If it's reasonable enough, to me, that's over 1%, 1.5% return over that 11 to 14 day period. I'll try to go to the debit spread if it's giving me that much extra. But if it doesn't fill, the bid-ask spreads are too wide, or I think the bid-ask spreads are too wide, I'm not even going to bother most of the time. I'm just going to stick with the bull put credit spread with a tighter bid-ask spreads, a better probability of getting filled at that midpoint, and the return that I want. Now, This is a decent return. I'm not saying it's the return that you have. Maybe I'd probably be shooting for the 14.9 at 82.5% probability. But no, I'm probably going here or here with the 12.4% return with the 84, 86% probability. I got to be honest with myself there. In these markets, I'm not taking too much chance. I want to say 85% or above if possible. So yeah, if I can get that return there, the 55 cents with the 86% probability, 12.4% return. I know it doesn't seem much, splitting hairs, but my goals and my approach is to stick with an 85% probability above or higher. And that's worked out for me fairly well in the right market conditions for bullish spreads. So I'd probably stick with that.